Welcome to vTalkInsight, Allocator's Lens Daily for January 27th, 2026. Strong U.S. growth and AI-driven earnings optimism are colliding with energy shocks, currency volatility, and record precious metal prices. That mix leaves equities looking calm while rates, foreign exchange, and commodities carry most of the stress. So understanding where risks are actually building across the stack is critical for portfolio construction today. In equities, the central story is still earnings resilience set against a noisy macro and policy backdrop. U.S. profit expectations remain strong, with forecasts for mid-teens earnings growth for the main large-cap index and even faster growth for small and mid-caps, supported by firm household spending and robust capital expenditure. Emerging markets are projected to deliver even faster earnings gains, helped by attractive technology valuations in Asia and higher commodity prices in Latin America. Beneath those upbeat numbers, though, corporate commentary sounds more guarded, with management teams flagging weaker consumer confidence and greater uncertainty around regulation and trade policy. That gap between top-down strength and bottom-up caution is where a lot of the equity risk now sits, because it will drive whether today's optimistic forecasts hold or are revised lower as the earnings season unfolds. The second big equity theme is AI and cloud, which continue to anchor leadership but also concentrate expectations. Cloud businesses at the largest U.S. platforms have been growing at eye-catching rates, helped by AI-related capital spending, and analysts have been lifting price targets for several of the major technology names on the back of stronger cloud profitability and resilient hardware demand. Investors are clearly more confident in the AI roadmaps of some firms than others, rewarding those viewed as core to AI infrastructure and inference, while questioning companies that spend heavily on data centers without clear recurring revenue visibility. Deals such as a multi-billion-dollar investment into an AI infrastructure partner reinforce the growth story, but they also raise concerns about circular financing and whether current AI-driven valuations can be sustained if productivity gains stay modest in the near term. Leadership is also rotating under the surface. Small-cap stocks have seen renewed interest as investors look for value away from richer megacaps, with the current move skewed toward higher-quality balance sheets rather than speculative names. That rotation is tightly linked to the rate backdrop, because smaller domestically focused firms are more sensitive to funding costs and local demand conditions. Globally, the balance of enthusiasm favors emerging markets over Europe. Emerging markets are benefiting from stronger earnings forecasts, improved fiscal positions in parts of the Middle East and Latin America, and currencies supported by the weaker dollar. By contrast, European equities face structural headwinds from softer earnings, heavier regulation, and limited fiscal stimulus, even as some flows have cycled back into European products and local defense, and energy names benefit from geopolitical and commodity themes. All of this is happening while headline equity volatility remains unusually subdued. Major U.S. indices have only slipped modestly after a strong small-cap rally, and the main volatility index sits in the mid-teens, even as foreign exchange, gold, and natural gas have seen outsized moves. That disconnect suggests abundant liquidity and a lack of obvious alternatives are still cushioning headline equity indices, even though the macro tape includes government shutdown risk, tariff threats, and severe weather disruptions that could shave growth in the near term. For equity allocators, the focus now is likely to be on how AI-linked earnings, small-cap performance, and emerging market leadership evolve against that backdrop of calm index-level volatility but rising event risk before we turn to what the rates market is signaling. Turning to rates, bond markets look orderly on the surface, but there are important fault lines underneath. Investors broadly expect the Federal Reserve to leave policy unchanged at the upcoming meeting, reflecting solid U.S. growth and inflation that is still projected to sit above the 2% target at year-end. The consensus is shifting toward only one additional rate cut, with further disinflation seen as the key precondition for any larger easing cycle. U.S. Treasury yields have been remarkably steady despite the surge in gold and safe haven demand, with the 2-year yield aligned with the policy rate and the 10-year near levels that many view as consistent with current fundamentals. Record foreign ownership of treasuries and strong confidence in the Fed's inflation-fighting credibility are underpinning that stability, even as political pressure and the search for the next Fed chair add noise. The more fragile part of the rate story is outside the U.S. Volatility in Japanese government bonds has already spilled into global fixed income, reminding investors that Japan's monetary and fiscal shifts now cast a long shadow over other curves. Upcoming long-end auctions, they're being watched closely for signs of renewed stress. Gilts are seen as particularly vulnerable to shock waves from Japan because of their high share of non-domestic holders, while U.S. Treasuries look less exposed and core European sovereigns such as Germany and France appear more insulated. Within Europe, 10 to 20-year German bonds are viewed as relatively cheap after the European Central Bank's earlier rate cut, and spreads on Italian bonds continue to compress as markets price less sovereign credit risk, even though fiscal questions have hardly disappeared. At the same time, there is a growing expectation that government bond yields may need to rise over time to reflect fiscal sustainability concerns and heavy issuance. That is leading many investors to prefer shorter duration exposure relative to traditional benchmarks, treating long-dated sovereigns less as a reliable hedge and more as tactical instruments. In the near term, markets are also digesting the prospect of a partial U.S. government shutdown, as well as shifting political dynamics in the U.K. that can move front-end gilt yields when investors fear larger spending plans. For multi-asset portfolios, the rates complex therefore offers stability today, but with asymmetric risk around Japan, deficits, and policy politics that could reprice term premia quickly, which brings us to how credit is being used to harvest income in this environment. Credit markets remain relatively well supported compared with sovereign bonds. Corporate credit is widely viewed more favorably than government paper, reflecting investors' comfort with corporate balance sheets and the extra yield on offer. In Europe, investment-grade issuers are seen as particularly resilient, with manageable maturity walls and income that appeals to carry-focused strategies despite the broader macro and political risks. In sovereign space, the ongoing compression of spreads between Italian bonds and German bonds highlights a broader trend of investors treating parts of the euro area as less risky than in prior cycles, even as questions about long-term fiscal anchors persist. Private credit is also in focus as a structural growth area. Recent deals, including a European firm acquiring a large U.S. credit manager and a major asset manager combining its European and U.S. private credit units into a multi-tens of billions platform, underscore how quickly this market is consolidating. Cross-border expansion suggests that institutional demand for private lending remains strong, with managers positioning to provide capital where banks are less willing or able to lend. That said, the growth of private credit also raises familiar questions about underwriting standards, leverage, and how this largely opaque market would behave if funding conditions tighten meaningfully. Policy and regulatory risks are starting to matter more for credit selection. In the U.S., uncertainty around possible credit card rules and broader regulatory shifts is creating headwinds for parts of the banking sector, even as aggregate credit conditions still look benign. Emerging market credit, especially in countries with strong fiscal and current account positions, is increasingly being perceived as relatively safer than in prior cycles, offering exposure without excessive macro risk. For allocators, the credit story is less about beta and more about issuer and regional dispersion, as policy, regulation, and growth differentials drive performance gaps, while foreign exchange now acts as a primary outlet for macro tension. Foreign exchange is where much of today's macro and political stress is being expressed. The U.S. dollar has weakened sharply, while the yen has staged a notable rally, with a multi-yen move in just a few days and daily gains of more than 1% at times. Markets are increasingly speculating about coordinated action between U.S. and Japanese authorities as the yen strengthens to levels not seen since late last year. Japanese officials have been signaling readiness to intervene, and reports that the Federal Reserve and the New York Fed are closely monitoring currency markets have heightened sensitivity to every headline. The result is a spike in currency volatility and growing concern that abrupt swings in dollar-yen could tighten financial conditions, particularly for investors who had built large, leverage carry positions. The flip side of dollar weakness is a tailwind for many Asian and emerging market currencies. Regional indices of Asian currencies and equities have been pushing higher, with the Korean won and Singapore dollar reaching multi-year highs, and a weaker dollar supporting flows into local assets. This move overlaps with a broader narrative of de-dollarization, as some global investors reduce exposure to U.S. assets over concerns about the current account deficit, debt levels, and trade and tariff policies. At the same time, there is skepticism about a broad-based Sell America trend. The depth and liquidity of U.S. markets and the dollar's entrenched role as the primary reserve currency continue to attract foreign demand for treasuries and other U.S. assets, even as portfolios slowly diversify at the margin. Looking ahead, many expect the yen's tactical rally to extend into the first quarter as long dollar-yen positions are unwound, and as U.S. policy signals keep the dollar on the back foot. Intervention risk in dollar-yen remains elevated, with markets watching closely for any sign of joint action or a change in tone from Tokyo or Washington. Trade tensions and tariff threats, including aggressive rhetoric toward key allies, add another layer of uncertainty that can quickly feed into currency moves. For global allocators, FX is functioning as both a pressure valve and a transmission channel, influencing the relative attractiveness of U.S. versus non-U.S. assets and interacting closely with the surge in gold and other commodities, which we will turn to next. Commodities are delivering some of the sharpest signals, starting with an extraordinary move in natural gas. U.S. gas prices have jumped more than 70% in a week and pushed above $6 for the first time since 2022 as a severe winter storm strains production and infrastructure. In Europe, benchmark gas prices have surged as well, with double-digit intraday gains, as the region leans heavily on liquefied natural gas import from the U.S., just as American export capacity is disrupted by weather. Options traders and large speculators had significantly underpriced weather risk, leaving them exposed as cold conditions persist and risk premiums stay elevated into later contracts. Beyond markets, the storms are causing widespread power outages, transport disruption, and economic losses estimated in the tens of billions of dollars, raising near-term inflation risks through higher energy and logistics costs. The energy shock is already reshaping sector performance and policy. European energy stocks are benefiting from higher gas prices, while energy-intensive sectors such as chemicals and some industrials face mounting cost pressures that could squeeze margins if elevated prices persist. In the U.S., authorities are temporarily suspending certain environmental regulations to maximize power generation from coal and oil plants, underscoring the severity of the crunch. Oil itself looks more stable in the near term, with OPEC Plus expected to hold production steady despite geopolitical tensions. So the most acute volatility is currently concentrated in gas and power rather than crude. Precious metals tell a different but related story. Gold has broken above the $5,000 mark, logging its biggest weekly rally since 2020 and gaining nearly 80% year-to-date, driven by safe haven demand, ongoing central bank buying, and concerns about fiscal imbalances in major economies. Silver has also surged, with prices roughly tripling over the past year amid strong industrial demand and heavy inflows into exchange-traded products. Mining stocks linked to these metals have rallied to record highs, and broader regional materials indices are at their strongest levels in several years, helped by themes such as AI infrastructure, defense spending, and a weaker dollar. At the same time, gold volatility has spiked above the mid-20s, and options markets are pricing meaningful risk of a pullback toward the high 4,000 range, highlighting that even perceived safe havens can deliver large drawdowns after parabolic moves. Beyond the immediate shocks, there's a structural story building across industrial metals and critical minerals. Electrification, AI, and data center expansion are expected to drive sustained demand for copper, platinum, and other key inputs, raising the prospect of supply bottlenecks unless investment keeps pace. Governments are responding. The U.S. has announced more than $1.5 billion in funding and equity stakes for a domestic rare earth producer, alongside substantial private capital, signaling a strategic push to secure supply chains vital for national security and advanced manufacturing. Bipartisan support is growing for intervention in critical industries like semiconductors and rare earths, reinforcing the idea of a multi-year bull narrative for parts of the commodity complex tied to the energy transition, defense, and AI infrastructure. For allocators, these moves in gas, gold, and industrial metals feed back into inflation risks, central bank options, and regional equity and credit winners and losers, rounding out a complex cross-asset picture. Stepping back, the cross-asset picture today features resilient equity earnings and expanding AI and emerging market leadership, set against a backdrop of record gold, a weather-driven gas shock, and a sharply weaker dollar. Rates markets still look calm, with U.S. Treasuries anchored by strong demand and a Federal Reserve on hold, but Japan-led volatility and fiscal concerns mean long-dated sovereigns are a less straightforward hedge than in past cycles. Credit continues to offer attractive carry, while dispersion across sectors and regions is being shaped by regulation and policy noise. Foreign exchange and commodities are acting as the main release valves for macro tension, translating politics, trade, and climate shocks into price moves that may eventually challenge today's subdued equity volatility. For allocators, key watch points now include AI and cloud earnings guidance, the evolution of U.S. inflation data and fiscal debates, signs of intervention in dollar-yen, and whether energy and metals prices entrench a more persistent inflation pulse across assets. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.